Is Samfam, and now we'll discuss how to write audit answer for the chapter Audit of Items of Financial Statements. First, we'll see what are the items of the financial statements. You see, items of the financial statement is all the headings that which we have in balance sheet and in a P&L account. So in balance sheet, we have share capital, reserves and surplus, and borrowings, and with regards to trade payables, etc. Right? And for the assets side, we have a PPE or intangible assets, and we also have some investments, inventories, cash. That's it. These were the few things. For the P&L account, we have some sales, and for the expenses side, we have some purchases and employee benefits and tax, etc. And now we'll discuss what are the things we have to use. You see, in order to write the answer with regards to audit of items of financial statement, first we have to know the prerequisites were this first paragraph. That is this first recall point for key point, and after that we require two key points on how to think. That is the way of thinking. This is something, the resources that we require in order to think. Okay, first we'll see these were assertions. Assertions were like a statements that were given by management. You see, responsibility of management is to prepare financial statements. They think that what assertion they'll give. You see, the financial statements were fairly prepared and they were accurate. And with regards to items of financial statements, what assertions they give with regards to, like, say, written representations for the trade receivables, they give that these balances are correct as far as our knowledge, etc. They give written representations like that. For everything, they'll give written representations like that only for every item of financial statements as we do audit. If you think these occurrence, completeness, etc., were like qualities for the items of the financial statements, for each balance or each kind of item in the financial statement, these were the qualities. Now, where those transactions get mostly covered in the two financial statements, that is either P&L or balance sheet, it is P&L. Most of the transactions, like sale transactions, purchase transactions, and all lease transactions, all majority of them gets covered in P&L. So regard this as a P&L. In P&L, what we have? We have sales. Okay, how a sale occurs? You see, what we thought that will be discussing two keys, right? Or in order to write audit of items of financial statement. First key is proprietary audit principles that we read in government audit. You see, what is proprietary audit principles? That is, you need to do business in order to make profit. That is, you need to have a sound business principles. And second key is you have to know what or from where all the resources we could get audit evidence, we could obtain audit evidence. That is our favorite question, right? Inquiry, inspection, observation, recalculation, reperformance, external confirmations. Okay, with these two keys, you could easily write the audit of financial statements. Okay, first, remember one point, that what all the management does in order to run a sound business, auditor checks that. Listen this very carefully. Listen that with a relaxed mind. First thing, how does a sale occur? You see, a customer will come and put an order to us, and what do? We transfer the stock. And after transferring, what do? We just provide invoices and etc. If at all he was a credit worthy candidate, or he's an approved candidate by our company, that there were no bad debts had been occurred due to this customer, could also give credit, will also give credit usually in that case. And there were a lot of transaction, lot of sales had happened with regards to the that particular asset or that particular category of inventory in a year. And later on, there were a lot of transaction that had happened even after the accounting period. Okay, and there were few discounts that were given with regards to sale price also. Okay, what are all the things? This is how usually a sale transaction takes place, right? Okay, in a business. Okay, our first key is what? Sound business principles. That is, you have to put on shoes of the management or the one who is doing the business. First thing, with regards to the sale, first you have to check for the occurrence. You see, in order you to give the written representation with regards to the sales, for the occurrence of that sales, what you need to have? You need to have some invoices or you need to transfer the stock, right? You have to transfer some asset, transfer the stock. That is what occurrence is. Second thing is completeness. You see, there were sales transactions in the accounting period and even after the accounting period. So what you have to compile all the transactions that had happened in your accounting period. And second thing is there were also transactions that happened after the accounting period. What you have to do? You have to include that also? No, you have to cut off there. That is cutting off. And the fourth one is measurement. That is the sale price. You see, you have given discounts to few and you have charged extra because you have given credit period to few, etc. Right? This measurement of the transaction. This is measurement of the value of that transaction, that sale transaction. So these were the qualities for a transaction that actually takes place. Occurrence. First of all, the transaction has to occur. And completeness, you have to provide all the transactions that were there in the financial statement and nothing has to be omitted in that accounting period. Third thing, cutoff. You have to not include everything, that is with not checking the cutoff point of the accounting period for which financial statements were prepared. So cutoff has to be taken care of. And measurement is the price at which the transaction takes place. These were with regards to the qualities of a transaction should have. That is the qualities of P&L account also. Balances. Mostly we see balances in the balance sheet. What is the difference between a transaction and a balances? Transaction, it's actually a event. Balance is by all these events we have got some headings in the of items in the financial statement and they were outstanding as on that date. It's a balance at an period of time. It is a balance at a end of the reporting period. As we have taken sales as an example for the transactions above, now we'll take plant and machinery is an example for the balances. Okay, what all the qualities should a balances should have? Existence, completeness, cutoff, valuation, rights and obligations. Okay, existence. Okay, what we have skipped, that is what are the qualities that are different from transactions and balances were occurrence and measurement. You see, it had been changed into as existence and valuation. Okay, what you do? You have to check occurrence of a transaction. That is, as we have said, transaction is an event. Balance is a situation at or end of a particular point of time. That is, a situation had existed or not. That is, a balance had existed or not at that time. And completeness is something that was common, and cutoff is also common. Measurement for a transaction, it is a measurement, and for the balances, it is a valuation. You have to check the valuation of that. Why measurement and valuation were different? Measurement, you have to measure at that particular when event occurs. Valuation, you have to value for the same balance, that is same P&L account for every year. Okay, you have to measure that situation, you have to measure that plant and machinery every at the period of every end of the reporting period. Okay, you're revaluing the same thing. That is why it is valuation. Measurement, you'll once measure and it would not be changed. Okay, and rights and obligation, because we deal a lot with regards to assets and liabilities, we have to also check the rights and obligation. That's something extra. Okay, first thing, plant and machinery existence. We have to check whether the plant and machinery actually exist or not. Like occurrence, we have checked the whether the stock in trade had transferred or not. Like here, when we purchase plant and machinery, whether the plant and machinery had been in our factory or not. Second thing, completeness. We buy a lot of plant and machinery, a lot, right? So whether all the plant and machineries were in the financial statements or not, we have to check that. Since we buy a lot of plant and machinery, is that we could like just add to all of them? No, there should be a cutoff date. You see, you cannot add the plant and machinery that have been bought after the reporting period. You have to add it in the next year, right? So there should be a cutoff with regards to that. And valuation, we know that we have to value that there's a lot of depreciation that takes place and impairment also have to be checked. So all this valuation also have to be given. and rights and obligation with regards to any kind of assets. If you have made only partial investment, so that partial investment would be in the balance sheet, but there was an obligation also to pay the remaining portion of the investment also, right? And you have to give that a disclosure and all. So these all the rights and obligations that you have with regards to, say, like any kind of you have bought a plant and machinery under hire purchase scheme, as you do not have a right to sell that plant and machinery because you have bought under a hire purchase credit, right? So you cannot sell that. These were the rights and obligation, and you have an obligation to pay a fixed sum with respect to that hire purchaser, creditor, etc. So there's an obligation comes with that plant and machinery. So these all the things, that qualities that are balance in the qualities that balances in the balance sheet contain. Okay, and with regards to, okay, P&L was over and balance sheet was over, now we'll come to the later part, that is notes to accounts and presentation and disclosure. Okay, presentation talks about the items of financial statement. Like presentations were like, you have to classify whether it's current or non-current, you have to describe that as it is an disputed or not disputed, or proper disclosures also have to be given. So the presentation deals with what are all the items that were present in the financial statement. Disclosure deals with all the items that were present as well as not present in the financial statements. Okay, we'll see. First thing is that items of financial statement have to be classified, described, and disclosed properly, and transactions have to be classified and presented fairly in the financial statements, P&L account, and determine the disclosures are complete and accurate. Okay, with regards to the disclosures here, and the information in any manner that does not omit or distort or mislead the user. These two are with regards to disclosures. First thing, the disclosure have to be complete and accurate, positive way. Information shall not be omitted, distort, or mislead the user. That is do not way. This is like a do way, this is do not way. Okay, positive and negative way of telling the things, the same thing, usually disclosures. And with regards to presentation, they are saying you have to be properly classify, disclose, and describe, and then you have transaction have to be fairly presented in the financial statements. That's it. With these three kind of things, see, these are the qualities of the transactions, that is P&L account for all the items in P&L account, for the balances these are the 5 qualities with regards to the balance in balance sheet, and presentation and disclosures were so simple. With these 3 things and our 2 kits, right, or 2 keys, we'll treat them as kit with regards to this 3, and 2 keys were, first kit is sound business principles, that is you have to put on the shoes of the management who is doing the business. Second key, you have to put on shoes of the auditor who is auditing, like how to obtain the audit evidence, like sources of audit evidence we have thought, right? Inquiry, external confirmation, etc. Okay, subject matter is items of financial statements. We have 3 things in hand, that is items of financial statement, that say it is like share capital here, or some borrowings will deal later on and sales later on. Okay, that is one thing. Second thing is 3 kit, that is these were qualities, 3 qualities: transactions quality, balances qualities, and presentation and disclosure quality. And 2 keys, what are 2 keys? First key is sound business principle, you have to put on shoes of management, and you have to put on shoes of the auditor with regards to sources of audit evidence, inquiry, inspection, etc. Okay, with that said, this is how equipping these 3 things you could easily write any kind of answer. Okay, first thing with regards to share capital, was that in the balance sheet? We'll see. Yes, share capital is in the balance sheet. Okay, this is an item of financial statement, we are dealing with that. Second thing, what we have to check, we have, it is a, since it's in a balance sheet, it is having the qualities, it should possess the qualities of existence, completeness, cutoff, valuation, rights and obligations. Okay, how actually they were presented in the balance sheet? There will be a schedule of the share capital, right? Opening share capital, and these have been issued and these have been subscribed, and this is the end of the share capital for the year ended, right? And what all the things that we usually have, how all the shares would be issued. First of all, the shares could be issued while for the FPO or IPO, or it could be just subscribed by way of ESOPs, and it could be subscribed by, it had be bought back by buyback of shares, etc. These were the kinds that could lead to change in share capital. So we have to do audit with regards to all these changes of the share capital. Now we'll see first what are the audit procedure. First you have to tally the things. Tally the every share capital will have a register that consists of opening and closing. You have to tally those things, tally those balances. Second thing, we have to write about few rules and regulations that we usually hear, that shares should not be issued at a discount. That's one thing. And obtain a certified copies of the relevant resolutions. You see, this is you're putting on the shoes of the auditor. Like how to obtain the audit evidence. First, what the management will do, management will do have some board resolutions that will be taken care of, right? While even while taking loan, since company is an artificial judicial person, the shareholders cannot what do, they cannot manage the company, so they will appoint board of directors to do the affairs of the company. If company is issuing the shares, what the board of directors have to do, they only have to do, right, they have to pass a resolution that these much of shares have to be issued and these have to be brought back, and it has to be issued at this price, etc. There should be a resolution that have been taken. For resolution, meetings, for meetings, minutes will be there. What the auditor has to do, okay, these you have thought all this by putting the shoes of the management. Now you have to put the shoes of the auditor and think how these have to be verified. Through what all the sources of audit evidence we could obtain this. First thing, inspect documents, that is inspect of minutes, inspect of resolutions, etc. Okay, and we have to check whether this is they're talking about increase and decrease in the share capital, etc. And you have to also or deal with the limits that were there in the authorized capital, etc. Why they have, you have to check the MOAs, etc. Because you see, board of direct shareholders only make the MOAs and AOAs. They are the owners of the company, but the board of directors were just managing the affairs. So someone who is actively participating in the company should not betray the owners, actual owners. So they have to perform their powers within the MOAs and MOUs. So we have to check that something that was widely taken by, something that was activities which are widely engaged by the management. As an auditor, you have to check that they are not betraying the shareholders. So you have to examine with regards to MOAs, AOAs, etc. And as with regards to the shares, what are the byproduct of shares issues, that is securities premium. There were some rules and regulations with regards to securities premium account uses, right? You have to write that, and that's it. What all you remember, like you could, the shares could also be reasons for changes in shares, that is you could be issued by sweat equity shares, or it could be given as for settling of any debt for the creditors, etc. And any kind of the things. And whenever there was you also know that whenever there is a change in share capital, you also have to communicate to the regulatories. So you have to also check that whether they have communicated with respect to regulators or not. These were the things you have to remember and write with regards to share capital. And this is also we have discussed in our frantic cover under schedule 3 disclosure requirements and all. You might check there. And now from now onwards we'll just discuss what all something points that were very well important. Now with regards to audit of borrowings, okay, first we have what items of financial statements, that is one, okay. And second thing is all the three kits, right, quality kits. Okay, now we have two keys, that is management key and management shoes and auditor shoes. Okay, management, first we'll go with the management. In order to take borrowings, what the management has to do, first management, what they have to do, they have to give a meeting. In the meeting they have to form a resolution, and then go to the bank and have meetings with the bank officials, and then put some assets of the company as a mortgage, or they could just pledge the some hypothecate the stock, etc., right? After that, or they might take some plant and machinery under any kind of lease agreements, etc. These were the things how a management could go out and borrow the money to the company. This is what the management do with regards to the borrowings. And now will go with the auditor's shoes. How the auditor has to check what all the actions that were taken by the management with regards to, since these were the balances, what we have to check? We have to check the existence first. Existence, whether the borrowing has been existed really or not. Existed means first what the management had done. First, management had done some meetings. What meetings? Meetings with regards to resolution to take loan or not, and how much loan has to be taken. You see, whenever, as we have discussed earlier, when a management was actively engaged in something, they have to, we have the auditor. The auditor's responsibility is to check that management is not betraying the shareholders. So they also have to check the limits or the powers of the management, or what amount, the till what limit they could borrow the money on the name of the company. You see, for that you have to check the MOAs and AOAs, and we'll see it now. For the existence, what we have to check as an auditor. First, you have to review the board minutes, review the or inspect. You could also the word use inspect for the any kind of documents. You could inspect the board review meetings and approvals of loan agreements, etc. Whenever the whenever the management goes and take loan, and there will be a loan agreement also, right? You also have to inspect the agreements there, and you have to check whether the limits, borrowing limits, were not exceeded or not. The limits were there within the AOAs or MOAs, etc. And the third one is you have to check the balances. You have to check the balances through how you could check by external confirmations. External confirmations you could check, and whenever the management had taken loan with regards to any kind of plant and machinery, etc., they have to. We also have to check the details of the leases and the hire purchase creditors were as per the agreement or not. We have to check for that. Hire purchase is something like purchasing of plant and machinery in case of EMIs. Yes, in case of EMIs, where the ownership would be transferred only in the payment of last installment, and we also have to, with regards to the rights and obligations. Also, as we have discussed earlier, right? We have to check that, like all the agreements, we have to check that. And when the debt is closed, not only while applying the debt, that is while applying the borrowings, we also have to check while clearing the debt. We have to check that while giving the borrowing, while we are taking the borrowing, management is taking the borrowing, they will pledge something. They'll pledge some assets, or they would put mortgage of some assets, right? While clearing of that debt, they also have to make sure that they were discharged from that. When we are making it as a mortgage, etc., when we are doing that, beneficiary name would be the bank's name, right? So we have, while clearing the debt, we have to check that the beneficiary name or the owner name should be the company's name. We have to discharge that. And auditor has to make sure that there were significant transactions, and he has to gain understanding with regards to that any insignificant, unusual transactions, mostly like related party transaction, etc. There were 3 points with regards to that, like unusual transactions or something related party transactions, as there's a lot of amount that was involved, and that is with regards to existence. And now with regards to the completeness, in a year a lot of loans would be taken, even after the year also a lot of loans would be taken. Now what we have to check, whether we have to include everything or not. How we know that, or what are all the list of the loans that we have taken? What the management has to do? Management has to maintain a register. Okay, opening balance this much, and we have taken from these many individuals or these many companies, etc., and these were the additional loan that we have taken from the same party, and these have been repaid, etc., and this was the principal amount, interest amount, and these were the loans that had been not actually matured, etc. We also have to maintain a list. So now what the auditor has to do? Auditor has to check whether the details were right or wrong. First, auditor has to obtain a schedule of borrowings showing the beginning, ending balances, and additional borrowings and repayments during the year which the management had paid. Second thing, consider any evidence of additional debt obtained from examination of minutes of the board, etc. Since this is also like inspection of minutes, that since we have been checking here additional borrowings, for this additional borrowings we have to check what all the board meetings on what all the minutes that board meeting minutes in which the resolution has been taken to enhance the additional borrowings, etc. And with regards to the debt activity, for review the debt activity for few days before and after the reporting period. That is, there would be kind of situations again, or we are dealing with the related party transaction. I'll tell you a situation where a director takes loan from the company from on say every year from May 1st and repays that on Feb 1st. Okay, whether this director's loan would be actually could be seen either in, okay, it could not be seen in beginning of the balance, end of the balance. So there makes sure that he was not there in the balance sheet and details of the balance sheet. It is like what we call as squaring of loans, that is repayment in the same within a year. So you see, he had been making utilize that amount for like 10 months without free of interest, etc., right? So whether we have to check whether in these kind of debt activities that were happening or not. You also could check like whether in order, you see, like a company who had been a defaulter for any kind of bank, it would be a reputation damage for that company, right? So the company had taken loan to repay the same loan in order to uh, keep maintain the reputation in the market. So we have to check the debt activities with regards to these situations and all. And we also have to check the external confirmation. This is obtaining of audit evidence to external confirmation for a like balance confirmations, right? This is, they're talking about the process. First, you have to mail the confirmation request to the selected party, bank manager or any kind of individual, and send the reminders for the non-replies. This is the follow-up action. And the third thing is compare the replies to the request, that is whether any kind of exceptions that were there, etc. And you have to reconciliation of the exceptions has to be done, and trace the reconciliation reasons with the supporting documents. And now with regards to the valuation, ensure that the loan balance and the loans payables are as per loan agreement. When we take a loan, we'll have a repayment schedule, right? Whether that balance in that schedule and our balance, the balance in our books of accounts have been tallied or not. And recalculate the interest also, as we have to check the principal amount, we also have to check the interest also, right? And computation of the amortization of premium or discount. And you also have to check the foreign current loans, that for the with regards to the forex rates, etc. And that's it with regards to the borrowings. And with regards to the trade receivables, it's a combination of sales. This is actually a balance transaction, but it has occurred through a sale, which is a P&L item. So you have to combine both the things with regards to trade receivables in order to write the things. First thing, whether the sales were to approved customers or not. So trade receivables is like giving trade credit to the regular customers, to whom you give trade credit. Someone who take away your stock and do not repay, that would become a bad debt, and it does not it is not the way that the management does the business. It is not as per sound business principles. How the management do, before giving trade credit to some trade receivables, what they check whether he is an approved customer of or not. Approved customer is nothing but who had not done bad debts for our company and who has some credit worthiness, etc. That's it, nothing much more than. And whether the sales were recorded or not. Why sales are recorded? See, it is mostly, it's a disguised loan in form of a sale transaction. So that sale agreement is only the kind of loan agreement which is evidence that he is due to us. And we have to also check that. And once the amounts are recorded, the debts can only be eliminated by receipt of the cash, and that's it. This is just a rule that what they have been talking about. And since we have given a loan, we have to also have a mechanism for collection. So debts were promptly collected or not, and if not collected, any follow-up transactions, follow-up actions system was exist or not. This is how a sound business do actually perform. This is how a business actually perform. Before giving trade advances or credit advances, what do they check? They check the credibility of that customer. And after that, even though the customer is so credible, etc., we need to have a proof. So a sale agreement. And after that we need to have a system to collect our debts. And for that, if they haven't done that, we need to have a follow-up actions, and we need to create an adequate provision for the bad debt if at all exist, and etc., and segregation of duties, etc. This is just an extra point. And with regards to existence, we have to check the controls to ensure that invoices cannot be recorded more than once. You see, this is one thing. And ask for the period and accounts with regards to trade receivables aging report, because even in schedule 3 we will have some trade receivables aging report, right? We have to, yeah, it's actually trade payables. Yeah, trade receivables aging schedule. So in order to disclose under schedule 3, we need to maintain that register. The management has to maintain that register. And since management maintains, in order to disclose in the schedule 3, we also have to, we all have come to audit the financial statements, right? What we have to do, we have to check the schedules that were prepared by the management. As simple as that. This is how we apply the three things. That is, one, item of the financial statement. Second thing is the qualities kit. Third thing is that management shoes and the auditor shoes. Okay, while putting that, you could easily write. This is how you usually do the audit. And first, we'll see existence with regards to trade receivable. Existence, how management will show us proof that these trade receivables were existed. What all the documents it have to maintain. Since trade receivables were caused due to sales, what is the document that they could form? They could just maintain invoices, the list of invoices for that trade receivable, etc. And second thing is the register of trade receivables for the balances, for the balance. So we have to just verify those balances and verify those invoices and just what are the things we could do with invoices. We could just reconcile it, with those invoices to the addition of that credit amount, that balance amount to the trade receivables, etc. And any kind of whether they have been properly accumulated to the balance register also with regards to trade receivables and all. We have to just give these 2 points with regards to that. And they have said that they have just given direct confirmation procedures, like they have gave it here, right? Just how to do that. First, you have, if you remember it from essays, you could directly apply that, then there would be no problem with regards to that. First, you have to select about the party, and you have to, you see, this was also discussed in the keyword kit, that was with regards to communication. I think 2 or 3rd one, I didn't remember that. Or do check that out if you remember. If you remember the skeleton of how the, or like a template of how any communication with regards to auditor communicating to the management or auditor communicating to third parties, etc., if you follow that template, it would be more than enough. You see, first you have to select the party's address, and you have to select the matter what you wanted to get communicated, and you wanted to select in what form it has to be done. For this balance confirmation, it could be either positive or negative confirmations, etc. You have to just go through that. You have to just write that process, etc. Or you could just go through that keyword kit for the confirmation. And with regards to completeness, for the completeness, what the management has to do, first management has to maintain a register. What the auditor has to do, auditor has to reconcile that with regards to the sales invoices, etc., because trade receivables were caused due to sales. Okay, we have to do that. And with regards to cut off provisions also, because there were balances, right? All the 5 things have to be written here, or need to satisfy himself whether there were proper cut-off provisions were there, etc. Because a lot of sale transactions happen in all the year, and he cannot combine everything. He has to cut off till the end of the reporting period. You have to just write that. And that's it with regards to that. You need not, first of all, don't get stressed with the amount of the matter that was in the audit of financial statements. Audit of financial statement, mostly they would discuss about the see, these were not rules and regulations. This is how it's, they're talking mostly about the process, right? These were where there'll be a lot of consideration would be given to your own views also. So if you remember the skeleton of how to do that, as we have segregated the skeleton for this audit of items of financial statement into three categories. If you put that and write it, how a business usually done, you just go through. This is just a 40 to 45 pages, and it is just a half side, right? So think it is as a 20-page document. Just give a 2 times newspaper reading, and this time while reading this, think it as a three-step process that we have done, right? Item of financial statements, and the qualities and the shoes of the management and auditor, right? Think in such a way. Okay, then it would be very easy, and you could easily retrieve in the examination. When you by heart all these things, you see, a human brain is not made to by heart. It is made to just react. It is made just to react to the situations that were given to that. Okay, and that's it. You try to react to the situations that were given to you rather than memorizing. Audit is mostly like a behavioral science. You see, these were not like scientific names, etc., of an doctor or MBBS syllabus, right? These were just normal how a human actually behaves while auditing a particular kind of balance, a particular kind of assertion. So, okay, these were the things, and you are what you have to do. You have to just review these things. Why I'm just skimming off through the whole PDF is that this is, you see, you're on the last day for your May 23 examination, so I have to move fast. And now, with regards to the quality of valuation, you see, valuation is the balance that would be shown in the financial statement. How these would be shown under like a schedule, that is these aging schedule, etc., like this, right? We have to maintain the balances with regards to how the schedule 3 recommends. So you have to just give it like this aging report, etc., like the same thing, and obtain a list of data under which you have disputes also. And you have to just give how you have to maintain the records in such a way that how the schedule 3 is demanding you to disclose that particular item with regards to balance of bad debts, etc., and the provisions and write-offs, etc. These all has to be given. And while you cannot simply write off a kind of balance, right? Because that's where a lot of frauds that might be happening there. So we have to check whether there were any authorization that will be given in order to write off. Okay. And with regards to audit of cash and cash equivalents, even we have discussed in our frantic cover with regards to disclosure requirements of cash and cash equivalents. Do not forget to check that out. You see, most of the schedule 3 had been discussed in the all the important points. Almost 60 to 65% of schedule 3 had been discussed in frantic cover. First 40 to 45 minutes. Do check that out after you have complete watching this, if you haven't watched the frantic cover. And with regards to cash and cash equivalents, how do we check usually the cash? We have to check whether first cash is the cash in hand. We have to check the counting of the cash with regards to the balance in the books of accounts and general ledgers, right? We have to check that. We have to verify that cash, etc. And do we have to check with information or not? We have to check with surprise checks. Usually while even doing your articleship, we usually have some surprise checks, right? Because money is not something, you see, whenever you go and check the inventory, etc., it is not something that anybody could adjust that. Because there were a particular kind of stock that was maintained or that was created by the company itself. But cash is something that was different. It could be easily manipulated because currency notes are currency notes everywhere, all towards India, right? All towards India. So that's why we need to have surprise checks, etc. And if there were more than one cash balances, like it is like the cash balances were segregated even in your accounts. If you do some examples with regards to sums with regards to petty cash ledgers, etc. There were there'll be a particular kind of cash balance that will be given for a employee who was actually doing the operations, like for petty expenses for like drinks to the customers, etc. You also have to, don't forget to add that, that is, you have to also apply to that cash balance also. That is, you have to check that, and you have to check the balance sheet date that would be arranged. And if it is not possible to check the cash balances as on the balance sheet date for all the companies you are auditing, so what you have to check, you have to check the movements of the cash in order to arrive to the balance as on the end of the reporting period. You have to maintain that. And that's what, whenever you're having any kind of cash expenditure, you have to check whether there was an appropriate signature of the approved signature of authorized candidate or not. You have to all check that. And you also have to check the since that is with regards to the cash, and cash equivalents are something that items that are easily could be convertible into cash, and you do not have any kind of rights or obligations with regards to that particular asset. So you could check that, simply say like it's you have got a check, that is a cash equivalent. So you have to obtain bank reconciliation statements with regards to that. And again, they have given a direct confirmation process in the auditor shoes. How do we obtain audit evidence with regards to some kind of balances? Through external confirmations. We'll just write confirmations to the bank manager while giving a balance in the bank account, balance of the with that particular company, etc. And checking the inventory. Okay, now we'll go back to a three-step process, that is audit of items of financial statements. In audit of financial statements, see first how inventory is related to other items of financial statement. It is related to sales, because whenever the sale happens, the inventory would be transferred, or it balance get reduced. Second thing, trade receivables, trade payables. When we purchase inventory, we'll be having trade payables, increase in trade payables if at all we bought it for a credit, etc. And with regards to trade receivables, when make a sale, we'll have trade receivables if we made that on credit. And third and fourth one is loans. Loans is that you could hypothecate the stock in trade and just get a overdraft or a cash credit, etc., right? So four balances were in relation with this inventory. So while checking the second step, that is like qualities of the inventory, what you have to check, it's actually a balance in the balance sheet, right? In order to check the five qualities of the inventory, you have to also influence the influence of all the four items, what we have thought: sales, trade receivables, trade payables, and loans have been taken by hypothecating this inventory, would also comes as a guest appearance with regards to qualities of inventory. Okay, now we'll see with regards to existence. We have to check existence like a inventory count. First we have to check whether that inventory exists or not. Second thing, what auditor has to do, auditor has to actually perform test counts, etc. And then ensuring employees counting as per management plan, etc. And this is all about the physical counting of the inventory. And there's nothing much more than that. And there was also some stock that was lied in the third party. What you have to do, you have to you may either go and physically verify there, or you could send a like a confirmation request for the third party. Third party is somebody like a job worker. You have sent some toys for you say you are like a toy manufacturer, you have been doing wooden toys, and you have sent that to the a job worker to paint that, because there exist some artisans for the nearby village and all. So they were the job workers. So you have to obtain a confirmation request, or you go and physically verify the physical count of the toys that were there in that village, etc. So these were with regards to existence of the inventory. And there were also be like inventory in the company's godown which is not owned by the company. That comes with the rights and the obligations, right? The company do not have rights with regards to that particular asset. They have own obligation to transfer that. So there could also be comes to there. And with regards to completeness, in like lot of inventory will be purchased and lot of inventory would be sold, you also have to make sure you perform analytical procedures with regards to that inventory. and you also need to have some non-financial informations also. As we say, analytical procedures is like comparison of financial and non-financial information. For the financial information, that is inventory turnover ratio is for how much inventory, that is like it is actually the cost of goods sold by the average inventory. And with regards to the non-financial information, we also have to check the quality of the inventory and the weights and the measures of the inventory that were there. And you also have to check for the, since it is for the completeness, you have to check whether there were any kind of clerical or arithmetical listing errors, etc., and whether the inventory was as per records or not. And you have to check that. And with regards to rights and obligation, we have checked that when we take loan, that is not the our right, we have an obligation, right, with regards to that loan, etc., and consigned goods, and with regards to any collateral agreements that were being there, and any kind of invoices or which should examine, we also have to examine the invoices with regards to the evidence of the ownership there, since inventory also involves uh, characteristics or qualities of the sales, since invoices comes with that, right? And that's it. These were the mostly things that you have to write with regards to inventories. And there were types of inventories: raw materials, working process, etc., finished goods. I don't want to waste your time here. And fixed assets also, since we have discussed plant and machinery with regards to that balances examination, right? So I'm not just repeating that again here. And you see, after this video, what you have to do, what is your call to action is read this 2 times, minimum 2 times. You have to read a newspaper reading with the format of how we have been analyzed that items of financial statement. Since there were inventory is not a single item, it will get influenced by the loans taken, trade receivables, trade payables, else, right? So you have to influence those items into the three quality sets, right? Since its inventory is a balance sheet, all the 5 qualities it has. And third thing is the management choose and the auditors. You have to read, you have to train your mind. This is not a memorization chapter, this is a training session. You have to train your mind to think in that way, in that path which have been fixed. And with regards to contingencies and provisions, you see, this is mostly asked as a disclosure requirement in Schedule 3, which have been discussed in frantic cover, and this is not important here. Um, and with regards to sales we have discussed in our transactions earlier transaction, and loans and advances were also the same. And that is just inspection of loans agreements, and before taking loans or giving loans, board have to meet and we have to check the resolutions, and then all that things would be there here. And other income, same. And same with regards to the purchases also, and employee benefits. With regards to employee benefits, first we have to check how an employee benefits would be raised. You see, employee benefits would be raised because we have some employees. How we had employees? Because we had recruited employees. You see, how we recruit employees through some hiring process will be happening there, and we'll just have a like offer letter, right? And that is agreement for service, etc. So we have to check all that agreements, etc., the process of the hiring process, whether there have been any related parties that have been employed, and whether the salary was as per market terms or not, and whether the any kind of PFs or contributions that were as per the MOAs or AOAs, and with regards to the any kind of acts. And now we'll see and put on management shoes and see how actually the entities hiring, appraisal, and retirement process would be there. They will have some internal controls, right, with regards to attendance registers, and payments or disbursement authorization, etc. As we have seen, like a petty kind of cash balance, right? Petty for all the petty expenses. There were few. The same thing, in order to disperse the payments, payroll payments to the employees, there would be a particular authority, say like HR, who disperses the authorizes the approval of payment, etc., to the finance department, etc. and computation of deductions like payroll taxes or provident funds or any kind of gratuity leave encashments. These are with regards to act. What all the benefits with regards to act have to be detected, and someone has to authorize the payment depending upon the attendance and the payroll master. Payroll master or employee payroll is a list of employees and their designations and their basic pay. All details would be given there. And with regards to the payment process, there has to be, company is something that was mostly of systems, right? So we also have to check whether that payment process, that is internal controls with regards to payments, were effective and they were reliable or not. Have to check that. And what the auditor has to do, what the management had done, done and had implemented some system to uh, make payment to the employees. What the auditor has to do, auditor has to test that systems. That's it. When management had conducted meetings to take loan, what the auditor had done, auditor had checked the minutes of those meetings. When management had made financial statement, auditor had come to audit those financial statement. Whatever the management had done, auditor will be behind, like watchdog, just to check whether management has done the things what its duties or responsibility effectively or not. We will see the detailed audit procedure with regards to employee benefits. Employee benefits, when it will come, when there were employees, when they hire employees, we have what the auditor will do. When management employees, when management employs new persons, we have to check the appointment letter, etc. When management had implemented systems for the payment, we have to check those internal controls and whether there had been any fictitious or ghost workers to just to inflate the employee benefits, etc. Just the salaries, etc. And if had the management had maintained the list of the employees, that is a payroll master, then what the auditor has to do, go and check the employees. And if the management had made some resigned some employees, or they have taken resignation, etc., we have to check the payments of that gratuity pf that they have been earlier deducted. And we also have to check whether like what are the reason for that resignation. You see, this is where comes a whistleblower policy, right? Like if the an employee had whistleblowed something, the fraud had happened in the company, then the management cannot remove the employee with regards to that. There is an immunity that was given for this what like his power or his authority, right? So auditor has to check why they have removed the particular employee, whether he had involved in any kind of like what like he had been for a good cause for the whistleblowing policy, or had been created any kind of disreputation, etc., or his performance have been done. We have to check that. And we have to check that there were any kind of for few employee benefits for under tax, there were also a tax deduction would be given. So we have to check the employees with regards to that also, like 30% of employee benefit expenditure would be given as a deduction by the government in India. So we also have to pay some more attention with regards to that. We have to check that. And we have to check the bonus, gratuity, leave encashment, any pf or esi, etc. We have to check all the things. And we also have to perform analytical procedures. What are analytical procedures? Comparison of financial and non-financial information. That is like say like payroll or total payroll expenditure with regards to the number of employees, etc. And we have to check the depreciation and amortization also. Since depreciation amortization is related to other items of financial statement, that is ppe. So we have to check whether the ratio of this depreciation, amortization and ppe intangible assets were good or not, whether the rate was effectively made, and whether depreciation had been applied to all ppes, etc. And you also just the influence of ppe would come under this audit of depreciation, etc. And you have to check the things that were with regards to this. And that's it regards to all some expenditures, travel, repair, maintenance, and that's it. And by the way, the last note that I wanted to tell you is audit of financial statement is something that would be overwhelming for you, because it has a vast content. But while you see the questions how it would be framed, it is very easy to answer. Just like they ask you about the completeness of PPEs, or in order to check the completeness of PPEs. So for the completeness, what are the management written representations it with? What are the evidence that management will give that it was complete, that the financial statement consists of a complete PPE that was bought, during the year, or that were existed in the year. It will maintain register and all. So what the auditor has to check, auditor has to check those registers, etc., right? You remember one thing, that the ICA does not test you the whole chapter, and moreover, it only tests you one question for only 4 marks. So when you put on the 3-step process, when you could easily figure out how to write the answer, but what all the call to action that I wanted to give you is, train your mind with that 3-step process and read it 2 times. You just read this one time now, and tomorrow you read it again, and that's it. You could easily figure out how to write the 4 marks question that would be given in your examination. And it would also do check the must do questions PDF, and there were 2 to 3 kinds of questions that were there, where they'll you just give a kind of a word, and you have to find out the assertion that has to be that they were trying to talk about. And again, with regards to the PPs and employee benefits, and do check that there were 4 to 5 questions with regards to this chapter. And that's it. Happy learning and all the best for your exams.